Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And last night I was thinking about today's presentation. What am I going to talk about? And I thought about those traders who are managing small portfolios, or maybe those that are just getting started in the realm of trading options, and they just want to take a small initial trade. So today we're going to be looking at three strategies that can be commonly traded for under $100. To some, they might call this the options trading starter pack. But in any case, we're going to be going through those strategies, showing example real-time trades. And then we're going to be planning and placing at least one of those trades. So should be a lot for just about anybody who might be just starting with options, who might be managing a smaller portfolio, or even those who have a larger portfolio but a smaller portion that have been allocated to options trading. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Great to see so many familiar names as always. Hello there, Paul and Josh, Mighty Mouse, Will, Alex, Eva, E. Dunny, Kevin, Eric, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy the recording. It's a great way to watch these webcasts, but also be aware that you're invited to join us in the live stream if you'd like to be here in our live audience. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Now, as a heads up for my live stream audience members, I want to let you know that my very good friend Mike Fairborn is going to be hanging out in the chats. Mike's going to be addressing any questions that I can't get to during the flow of the presentation. I see that he's already been chatting back and forth with some of our attendees. Thanks for having my back there, Mike. Also, Mike and I would like to issue an invitation to everybody listening to follow us on social media. You can find Mike and me on X. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. You can also follow me on LinkedIn. Just go to linkedin.com/in/Cameron May CS. That'll take you to my profile and you can give me a follow there. But let's get into this discussion. And of course, the strategies that we're going to be discussing carry risk. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. While this webcast discusses technical analysis, other approaches, including fundamental analysis, may assert very different views. Investing involves risks, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for today's discussion. As I mentioned, we're going to be going through three options trading strategies that can be commonly traded for under $100. We're going to talk about how we might find stock candidates for those sorts of strategies. We'll talk through each of the three strategies, and then we'll plan example trades associated with those. So should be an interesting discussion. Let's go right to the thinkorswim desktop platform. And we're going to launch right into strategy number one. Now, as we do, I think it's natural for somebody to ask, Cameron, how did you find the example candidates for today? Well, for traders traders who are looking to trade lower priced strategies, they might focus on lower priced stocks. However, very commonly, liquidity is a key because low price stocks can tend to have less liquidity than some of the higher priced, maybe more heavily traded securities. And when a stock is thinly traded, its options tend to be even less heavily traded. And we'll see that impact the pricing of the options. It can cause what we'd call wide spreads between bid prices and ask prices, making it harder to get into or out of those contracts. So I just wanted to show you very quickly how a trader might find example candidates for trading these sorts of strategies. So what I'm going to do over here in the left column, let's load up a watch list of the S&P 500. And we can do that if we don't have the S&P already. We can just click on the watch list heading, go to the public watch list. These are maintained and published by thinkorswim, and we can find the S&P 500 right there. And this is going to show us the component companies of the S&P 500, and then we can organize those by market capitalization or by last trading price. But these are going to be among the most liquid stocks really on the planet. Now we can keep an eye on in this column titled Last. We can see the last trading price, and really this may be a focus for a trader looking for lower priced options. Let's make price a priority for this discussion. I'm going to click on Last, and this is going to organize the 500 companies of the S&P 500 from lowest price to highest price. I'm going to click on that one more time just to show how you can then organize from highest price to lowest price. So for example, Booking is trading at $5,400 per share. But we can just scroll down through this list. And for a trader who's looking for lower priced options, maybe they start looking in the double digits. Stocks that trade in the triple digits will tend to be relatively high priced, even if their options are short term. So this is where I focused the search for today's examples. And I really just started looking through these and looking at charts to see how the charts are behaving. So that's a quick way that we might look for some of the most liquid stocks, and we can sort by price. All right, so our first example here is going to be NextEra Energy, and our first example strategy is going to be purchasing a long put option. Now this is a bearish strategy. I'm going to do one bearish strategy and then two bullish strategies. But let's set a very basic context for why a trader might be looking at this as a bearish trade candidate. Obviously, I have no perfect insight into what a stock is about to do. But what a trader might do with what they might note with NextEra is this is a stock that really tends to move up and down in pretty sharp and large movements. So for example, when it runs up, it's had a tendency to run up $6 or $8. When it pulls back, it has a tendency to pull back $6 or $8, up and back and up and back. You can see that that has persisted right up to recent trading, where we've seen a pull back, a little bit of an effort for a recovery, and it looks like we might be starting into a new series of lower highs. Maybe our trader sees this, they might call this a shooting star candlestick. Or if they don't know candlestick patterns at all, maybe they just think the stock is overdue for a pullback. So let's just make that our basic assumption for this bearish trade. I don't want the focus to be on charting, but rather on strategy. All right, so let's say that our trader thinks that if we've been seeing retracements of about $6 on a swing down, maybe we'll see another one. Here we are trading at about 80 bucks. A $6 move to the downside might take us down to $74. So strategy number one is let's buy a long put. So what is a long put? With each of these strategies, we're going to be talking about getting into contracts with other market participants. And in this case, what we're going to do, go to our trade tab, and with the stock trading close to $80, let's look at 80 or 79, and we're going to be looking at the puts. So for example, we'll notice the $79 put is priced between 77 cents and 83 cents per share. Now, these are standard contracts representing the potential exchange of 100 shares of stock. So if we were to buy the $79 put, it looks like it might cost us, let's just call it 80 cents per share. Times 100 shares, that would be an $80 trade. So here's our example strategy number one. Example strategy number one is known as a long put, in other words, buying a put. And for our example trade, let's say that we buy the 16th of January, $79 put, and that looks like it's trading for about 80 cents, or in other words, for 100 shares, about $80. So what exactly is the trader doing here with their $80? Well, as I mentioned, we're getting into a contract with another trader where we are paying them a premium, it's essentially an incentive, to make a contractual promise to us. This $80 is purchasing for us the right to sell shares for $79 per share at any time for the next 17 days. That's what we're paying for. So How might that translate to profits for our trader? Well, if the stock were to fall, let's just look at this as our best case outcome. Now, obviously, this is not, I don't know exactly where this stock is going to go. It might go up. But let's say that it does go down $6 and it goes down to $74 before the 16th of January within the projected time frame here. So notice this line is just really mirroring this line. So anticipating a retracement equal in distance and time frame to the last one. So if we happen to fall down $6 and the price goes to 74, well, according to the terms of our contract, this trader would have the right to sell shares for $79 that are now worth only $74, or that contract would be worth at least $5 if we get that pullback in the stock price. So this is known as a put option because conceptually the trader would have the right to put shares that they would like to sell into someone else's account through sort of the enforcement of a contractual right. So that is strategy number one. Now, are any of these guaranteed to work? Of course not. How could this trade fail? Well, this is a big if. The if here being if the stock goes down in price. If the stock, on the other hand, goes up in price for the next 17 days or really just doesn't go down at all, well, now we have the right to sell shares for less than they're worth. That's not a right that carries any value. So that's how a loss might be incurred on this strategy. But I think you can see for some traders why they might be attracted to a trade like this. Now, this is not a promotion for a specific approach or for a specific trade. But for some, they might look at this and say, so for my 80-cent investment, if we were to get the move that we're anticipating here, this thing might be worth $5 at the end of this trade. Could it be worth even more? Yes. This is not a high probability outcome. I think you can look at this and realize the stock may not go down, and if it does, it may not go down as far as $74. But that is strategy number one. That is a strategy. For some, they might have it in their starter toolkit where if they're just trying to dip their toe in the water, take a trade that is maybe less expensive. Theoretically, the most we can lose on this trade is if the stock doesn't go anywhere, could lose $80. Now, there is a possibility where this trade might turn into a much more expensive trade. How might that happen? Well, let's suppose that our trader buys this put, the stock runs down, and maybe they didn't intend to actually sell the stock. Maybe instead they intended to just wait for the put to grow in price, maybe sell it for $5 or $4 or whatever they could sell it for. And they allow it to get to expiration and the contract is exercised on their behalf. If the stock is below $79 at expiration, if we allow this contract to get to expiration, it will automatically be exercised on the trader's behalf. In other words, shares will automatically be sold for $79 per share, whether the shares are actually in the position of the trader or not. So we might wind up selling shares we don't own and establishing what's known as a short stock position, and that can carry its own risk. All right. So option 66 saying, what was the gamma on the put? I'm not going to go that deeply into these strategies. My apologies. That would be go a little bit deep in the weeds. It wouldn't leave time for the discussion of the other two strategies, but certainly there are other things to learn about these strategies. So just as a heads up, if you are new to these, I've actually made a series of lessons where we explore these strategies individually, dedicating an entire 45-minute presentation to each one. And you can find those by, first of all, if you haven't done this already, make sure that you've subscribed to our Trader Talks channel on YouTube. So our channel is called Trader Talks Schwab Coaching Webcasts. You can join our live streams here, but you can also find playlists of previously delivered webcasts as videos. So I'm going to go to playlists. If I scroll down a bit, actually scroll down a lot, this webcast series happens to be right down toward the bottom. There's my Getting Started with Options webcast series. What I would suggest you do is go to the full playlist and then scroll down. It'll take you a minute or two until you see the word lessons right there, lesson. There's lesson 1 through 10, and lesson 1 starts right with one of the strategies that we're going to be discussing today. Lesson 2, what do you know, is all about long puts. And if you want to learn about Greeks, like for example, the question there about options, who was that? Option 66 asked the question, what about the Greeks? Well, lesson 5 reviews the Greeks. All right, so back to our second strategy. That was example strategy number 1, a long put. We discussed how it might work, how it might fail, and also how it could become an unintentionally much more expensive, much more risky trade if we allow that to go to assignment. What about example strategy number 2? This one, very similar strategy, but actually significantly different, is buying a long call. So for this one, let's go have a look to see what's going on with Pfizer. Here's Pfizer, also selected just from that same watch list that I went through earlier today. But Pfizer looking a little bit different than our first example. This stock has been stair-stepping its way higher, again, moving in sort of broad strokes, running up and pulling back and running up and pulling back. But it appears to be advancing along a sort of an invisible ramp. We might refer to this as a potential price floor or a support area. And recent activity has taken us right down close to support. Yes, we're down a little bit today, but for some traders who are looking to get into bullish strategies at or near lows, it's necessary for price to go down to position near lows. So in this case, let's just say that our trader thinks that we're right around $25. Looks like we're settling in potentially at a price floor, and they think maybe price might advance from here, running up. Could be up to previous ceilings around 26.5, possibly going up to 27 or higher. So how might we take advantage of that? Well, we might just buy the stock, or a trader might enter into a long call contract. So in this case, I'm actually going to go out a little bit further in time. Our first trade was just a 17-day trade. This is right now it's December 30th. This contract ran through the 16th of January. But for our second example, let's get into a contract. Let's see if we can, for under $100, get into something that allows us to potentially exchange shares for the next 52 days or through the 20th of February. Now notice this is a lower priced stock. Our last stock was around $80. This one's about $25, so lower priced stocks tend to have less expensive options. Let's go have a look at the call side of the equation. And in this case, with our stock trading right about 25 bucks, let's look at the $25 call, and this is going to be our example. We're going to buy, as an example, theoretical example, the 20th of February, $25 call, and that looks like that's trading for between 67 cents per share and 69 cents per share, or in other words, let's say we are able to get that filled for 68 bucks. Obviously, a trader doesn't know for sure that they can get an order filled if and until that order actually fills. So, LeBlanc says, what made you pick Pfizer? 3 things: price per share, liquidity, and what was happening on the chart. So in this case, it's one of the biggest companies in the world, so highly liquid compared to lots of other companies, lower priced, $25, and the stock seems to be in an upward trend, but at an apparent price floor. Just because I've drawn a line on a chart doesn't mean it's an impenetrable obstacle for price. We could still go down. All right, but back to our trade here. Let's look at, and Mary Burns says, any consideration of earnings on February 3rd? Yeah, earnings could cause this trade to blow up, or it could accelerate the potential for reward. Now, with this trade, if we're spending 68 cents, how much is at risk for this trader as long as we don't allow it to get to expiration and get exercised? Maybe the trader doesn't want that. Should be just $68 at risk, even if that earnings just goes terribly. All right, and obviously we're setting commissions aside in these discussions. For each contract, there might be a 65-cent commission. to be added to this. So instead of being an $80 cost, it might be $80.65. This one might be $68.65. But what does this $68 accomplish for this trader? Well, if they spend that money, it looks like it's gotten a little bit, maybe it's $69, maybe it's $70, still well below our $100 threshold. But here our trader is spending, on the order of about $70 for the right to buy 100 shares of Pfizer at any time for the next 52 days, or in other words, through the 20th of February, for $25 per share. So let's go back to our chart here, and let's actually maybe zoom this out a little bit more. Let's change our right expansion settings. Right now I'm showing 20 days of extra space off to the right of our chart. Let's maybe add 40 days, 40 trading days. Let's apply that to our chart. That allows us to peek out into the future. There's February 20th. And if this stock gets a nice tailwind, how high might it go by February 20th? Well, we could look at sort of exaggerated examples. Maybe it gets to $27, maybe it gets to $28, maybe it doesn't. But the higher that goes, our trader here still has the right to buy shares for $25 per share. So if it's up there worth $28, our trader has the right to buy shares for $25. That would be a $3 discount, a $3 value for which they paid 68 cents. That would be about a quadrupling of their investment. So that's obviously looking at things from the brighter side, but that's why some traders will buy a long call option. And for those that are managing a small portfolio or dipping their toe in the water with a lower priced option, each of these, one in a bearish direction, this one in a bullish direction, might help them contain how much is being committed to each trade. All right, so this trade, yes, it works out best if the stock goes up, and the further it goes before we hit our deadline, the better for the trade. How might this trade fail? Well, what if we just go sideways or we go down? If the stock is going down and we have the right to buy it for $25, that's no good. This trader now has the right to overpay for shares. There's no value in that. And when the clock runs out, if the stock is not above $25 per share, there's zero value in that contract that they paid 68 cents for, and they might lose that whole amount. So now a final consideration here is I'm trying to contain costs. That's what the trader's motivation is. Well, this could become a much more expensive trade again if our stock is above $25 to any extent. Why don't I just do this? Let's just pop it right up there at the 27 bucks. I'm going to remove this. Let's say our trader buys that call. The stock is running up and they allow it at expiration. If it's above $25, if they allow that to expire in the money, the contract is automatically assigned or exercised on the behalf of that trader because it has value. This thing is worth $2 per share. If the stock is at 27 and they have the right to buy the shares for 25, that's a $2 per share value. They only paid 68 cents for that. In an effort to retain that value for their client, the broker automatically exercises the contract. Well, what does that mean? It means they buy the shares for $25 and they have the shares purchased within the trader's portfolio for $25 per share. Well, that's a $2,500 investment. We're no longer under our $100 threshold. We've gone way beyond that. Now, is that a tragedy? We just spent $2,500. Well, the trader could then sell those shares conceptually for $2,700 and realize their $200 gain. But yeah, for the moment, they could have a lot more out of pocket. And of course, if they buy the shares at $25 and the shares subsequently collapse in value, there's risk there. So now Eva says, couldn't our trader here just leave instructions with their broker? They could call the trade desk and say, hey, I need to enter a do not exercise order. They could. If they If they really feel like they might fall asleep at the wheel, they might do that. However, just realize if we tell our brokerage firm not to exercise, they're not going to exercise. And if let's say our contract rockets up there, it's a 50, I'm going to exaggerate just to really hammer home this point. Let's say it just blasts off. Pfizer just announces the best product in the world. The shares go to $50 per share, and we're thinking, oh, good, I have the right to buy the shares for $25. And I know if the stock goes up, if we hit expiration at $50, I'm feeling contracted, we get exercise. No, it won't. We told them not to. And that $25 per share of value evaporates. So there's a risk in leaving those sorts of orders. I just want to make you aware of that. But in any case, there is strategy number 2, which is buying a long call. Our example here would be about $68 or $70. So yep, definitely under our $100 threshold. Let's go to strategy number 3. Strategy number 3 can sometimes allow a trader to trade options on stocks that are even a little bit higher in price. But it actually involves 2 different options. We're going to be doing a long call vertical spread. So this one, might as well title this one correctly. That's strategy number 2. Strategy number 3 is going to be a long call spread. There we go. Let's spell that correctly. So this does involve 2 options. We're going to get into a contract that allows us to buy the shares at a specified price, but at the same time get into a contract that allows someone else to buy those same shares from us at a higher price. So if the contracts get exercised and assigned at expiration, if they're in the money, we might make the difference between the 2 prices. So here's what I'm talking about. Let's go to another example stock. I have a couple here that I was looking at before the webcast started. Could start, well, let's look at ConocoPhillips. So here's COP. You'll notice it's had a price floor at about $90. That was a ceiling for about 7 weeks, and it looks like it's acting as a new price floor again. We're even bouncing up off of that as we speak. Stock's trading around $94. Let me go look at the trade tab. And let's see if we can structure a long call vertical spread for less than $100. So here's what we might do. Stock's trading at about $94. Let's look at, yeah, I think we can pull this one off. Let's maybe look at buying the 16th of January. Let's look at buying the $93 call. And that looks like that's trading between 235, 272. Let's kind of split the difference. Let's call it 255. Now, at the same time, we're going to enter into a second contract. Same expiration, same stock, but just a different strike price. And that $94 call, we're going to sell. And that looks like that's selling between 193 and 215. Let's call it 205. So this is our trade. What we're doing here is we're simultaneously spending $2.55. You would say, Cameron, wait a minute, that's way over $100. Yep, that's $255 being spent to give the trader the right to buy shares for $93. But at the same time, we're going to sell or collect a premium of $205. And in this case, we're taking on an obligation. Here we have the right to buy shares for $93, and we're going to allow someone else to buy those shares from us for $94. That would be a $1 profit. Doesn't sound like a lot, but we're not committing a lot to this trade. How much is being committed here? If we spend $255, but at the same time collect $205, that's a net $50. That is definitely under our $100 threshold. For that $50, we now have the right to buy shares for $93, but the obligation to sell shares for $94. Well, hey, if we buy 100 shares for $93 and then we sell 100 shares for $94, according to my math, that's a $100 profit. Except it costs us $50 to set this trade up. So it'd actually be a doubling of the investor's money if this trade works out, turning a $50 investment into a $100 value. That is actually what the trader is shooting for here. So notice we're trading contracts that are more expensive, but because we are buying and selling, the net cost out of the account is lower than our $100 threshold. So this sounds pretty cool. Okay, we might double our money on this trade. How might that happen? And how might we actually wind up losing? Instead of doubling from 50 to 100, what if we go from 50 to 0? That's definitely a possibility as well. And is there a way that this could become one of those really much more expensive trades? So let's look at ConocoPhillips. So here the stock has been bouncing off its support, and we just decided that we are going to buy a contract at $93 and run it out here to the 16th of January. And we're going to sell a contract at $94 and run that out to the 16th of January. That kind of visually represents our trade. And what we're looking for with this trade is for the stock to be up here, anywhere up here, doesn't matter where. But this is the objective of the trader. This is going to be our green zone. Because what might happen if the stock goes up there above $94? Let's say it's up here at 95, 96, maybe it goes all the way up to the $98 price ceiling. I don't know. But if it's up above $94 and we have the right to buy shares for 93, are we going to do it? Sure. So our contract is exercised. We buy the shares for 93. Well, at the same time, someone has the right to buy those shares from us for $94. Are they going to do it? Yes, with very rare exceptions. They buy the shares for 94. So if we buy it for 93, sell for 94 because the stock is higher than that, that is our maximum realized gain. $100. It's $1 per share times 100 shares. So that would be $100 value for which we only paid $50. So that would be a doubling of our investment. Now, that's if the stock is above 94 as we move to that January expiration. What if it doesn't work out? What if the stock goes down below 94? Is that a possibility? Even though we think the stock is going to continue to rise, could it fall and come January 16th, it's down here? Yeah, it could. So in that case, let's say our shares are worth $92 at the January 16th expiration. We have the right to buy shares for 93. Do we want to do that? Probably not. Nope, that'd be overpaying by $1. So our $255 investment is lost. At the same time, someone has the right to buy our shares for $94. They're only worth 92. Are they going to do it? Probably not. They could if they want to. Overpay us by $2. They can if they want to. That wouldn't be necessarily a tragedy. But most likely, with very rare exceptions, they just say, Cameron, I'm out of here. Keep the 205. I don't want to pay $94 for a $92 stock. So we lose $255. We keep $205. That's a $50 loss. So is that disastrous? Well, it's under the $100 limit that the trader set for themselves. So that's how the trade could work out optimally. That's how the trade could also fail. Now, a final way for this trade might wind up if we allow this to go to expiration is what if, let me activate this drawing, what if we just slip between 94 and 93? What if we're at 93.50? We have the right to buy shares for $93 or worth $93.50. Great, we buy those shares at a discount. Someone else has the right to buy shares from us for $94. They're overpriced. Nope, not going to pay $94 for a $93.50 stock, and they just allow their contract to expire worthless. So in other words, we just bought some shares and there was not a seller on the other end of the line, not a buyer for our shares on the other end of the line. So now we just have the shares. Bought them for 93. So we got them at a 50-cent discount. That's great, except we paid 50 cents or $50 to set this deal up. That would be a wash. And now we own shares of stock. and the shares could go up, they could go down. There's risk and reward potential in a new way from there. So just be aware, yeah, we could wind up with ownership if we wind up below 94 but above 93. Option 66 says, is the buying and selling of shares at assignment or you mean at expiration maybe, automatically taken care of by the broker? Yes. Yep. At expiration, if both contracts are in the money, they will both be, well, the contract we bought will be exercised. The contract we sold will be assigned. That happens automatically through a process known as same-day substitution, unless the owner of the contract that we sold left a do not exercise, left those instructions with their broker, which is possible. It just doesn't happen very often. Yeah, so the vast majority of the time, we just wind up buying the shares and selling at 94. Okay, let's see. Ram says, how would you close the contracts? Should we go ahead and place this trade? How about we do that? Let's go to our trade tab. I'll show you how to quickly place this trade. We can come up here where it says spread set to single, and it's showing all the individual strike prices. I'm going to change that to vertical. So it pairs up the strike prices one with the next. So there's our 93 paired up with our 94, and we can just click on the ask price to create a buy order. I'm just going to do one contract, keeping to that $100 maximum that I've set for myself. And notice there's a difference between what the natural or basically the market price of these contracts down to what's called the mid or halfway between the bid price and the ask price. Let's say that we're willing to spend up a bit here. Let's say we're willing to spend maybe 75 cents per contract to get into this trade. Let's set that as our 75-cent limit. It's not 50 cents. Notice the price has moved already. In any case, so in this case, we might be spending 75 cents to set up a deal where we might turn that into $1. Turning 75 cents into $1 is only a 25-cent profit. But how about we do that? And well, let's see. Ram says, how would we close this? So we're hoping for this to increase in value. What if it starts to decrease? How about we attach a stop order to get us out if this is starting to fall in value, where we've invested 75 cents, and maybe if it's dropped to 25 cents, we'll pull a plug on it. Here's how we might do that. Instead of just putting in a single order to enter into this contract, into this vertical spread and let it go all the way to expiration, let's change this to a first trigger sequential order so that our first order, if it fills, our order to get in, would trigger a sequential or a closing order. And to create that closing order, we'll just come up to the original, right-click on that, and create an opposite order. And so this enters an order to sell the calls that we bought, or the call, buy back the call that we sold. But we don't want to do that. We don't want to enter this spread for 75 cents and then immediately sell it for 75 cents. That wouldn't make anybody any money except for paying commissions. Let's put in our stop at 25 cents. Stop the bleeding. This is going the wrong direction. I want out. Let's make that a good till canceled order. So that will remain in effect until expiration or until it's filled. So there we go. This is going to be our example trade for the day. It's under our $100 threshold, even though we're dealing with more expensive options. Let's click confirm and send. Going to buy this one vertical for 75 cents or less. That's the limit that we're putting in. It may not fill. If we can't get in for 75 cents or less, it just won't fill. If the value then drops, we have a stop order at 25 cents. That's not a guarantee that we will close out at 25 cents. If it's falling hard, we might close out for less than that. It just kicks in a market order at 25 cents. But there are commissions to get into these contracts and then potentially get back out of those. So let's send this order off. And we'll see if that fills. Let's go to our working order. Oh yeah, look at that. So we filled that for 59 cents. Okay, that's not too far off our original trade scenario. We were talking about buying into this for 50 cents. It actually cost us 59. Trying now to turn 59 cents into $1. If this trade works out, we'll nearly double our money. It's more like 80%. All right, guys, we have accomplished what I set out to do today. I wanted to talk through what some might call the options trading starter pack. 3 strategies for under $100. So I hope this was helpful to you. This is what we do on Tuesdays. We explore principles of sort of getting started with options trading. Now, I have other webcast series that run throughout the week as long as the markets are open. We are not open on Thursday, of course. I think everybody recognizes that, but we have normal market hours on Monday and on Friday. So make sure that you're watching our webcast on Wednesday and on Friday. Make sure that you're watching the webcast then. If you haven't done this already, make sure that you have subscribed to our Trader Talks channel on YouTube called Trader Talks Schwab Coaching Webcasts. But this is where you can join our live streams. You can find our playlists here. And you can even do keyword searches through our archives for topics of specific interest. So for example, there was a question earlier about one of the functions on testing strategies historically. Well, there's a tool called On Demand that might help with that. So I might do a search for On Demand, and hey, there's back testing a new strategy with Thinkorswim's On Demand. There we go. In any case, guys, thanks for giving me your time today. Mike and I would like to issue an invitation to you to follow us on social media. You can find Mike and me on X. Mike is at Mike Fairborn CS. You can find me on X at Cameron May CS. And if you reply to one of my posts on X, I just try to reply right back to you. It's a great place to connect with your favorite presenters in between these live streams. Now, you can also now follow me on LinkedIn. So you go to linkedin.com/in. That's sort of the standard prefix for finding somebody on LinkedIn. But for my handle, it's /Cameron May CS. That'll take you right to my profile. You can give me a follow here. And I make longer posts on LinkedIn. And if you reply to these posts here, I try to reply to you as well. There we go. All right, everybody. Thanks for giving me your time. Thanks for all the people that have already given the thumbs up out there. 151 people watching the live stream right now. I can see 48 have already given a like. That is definitely appreciated. It's a pat on the back to your presenter for a job well done, but also it gives my webcast a boost in the YouTube algorithm. It lets YouTube know that those who watched this webcast enjoyed the webcast, and it'll then promote the video to more people. Might help more people find these things. Alex says, is there a way to ask you questions directly? The best way to contact me, again, is through social media, through X or through LinkedIn. I don't have like a public email or anything like that. All right, everybody, thanks for giving me your time. I will look for you in a future webcast. I'll also look for you on social media. If I don't see you again before the new year, have a great holiday. But whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.